Modern capitalism isn't built on your hard work. It is built entirely on dirt. That is the core argument of The Land Trap Bird by Mike Bird, which we are decoding today on Nonfiction Insights. We're going to look at why the world's most valuable asset creates an inescapable trap that actually chokes off economic dynamism.
I mean, I have to challenge that hook right out of the gate, because if you just look out the window, you see a global economy driven by, artificial intelligence, automated logistics, highly complex silicon chips. So to say the whole thing's built entirely on dirt seems like it completely ignores human ingenuity. It ignores the massive technological leaps we make every single year.
It sounds reductive, absolutely. But Bird's focus isn't on the shiny output of the economy. He is looking clinically at the underlying mechanics of how that output is financed. And to understand this, you really have to grasp what he calls the asset utility paradox. The economy fundamentally requires land to act as an affordable utility. If you are going to, say, open a warehouse or build a semiconductor plant, the physical ground it sits on needs to be a cheap, manageable cost. But concurrently, the global financial system requires that exact same piece of land to act as an appreciating asset. It serves as collateral for massive loans. It acts as a primary storage of wealth. So you have this severe structural contradiction. An asset simply cannot simultaneously be cheap to use for the producer and increasingly expensive to own for the investor.
But isn't that just basic supply and demand? Prime real estate should be expensive. If a location has incredibly high utility, let's say it's right next to a major shipping port or inside a booming tech hub, it's naturally highly desirable. And because it's desirable, the asset value goes up. That is just the free market efficiently signaling value. Why are we labeling prime real estate being expensive as a systemic trap rather than just a functioning market?
Because the banking system has completely rewired itself to exploit that dynamic, which brings us to the credit collateral engine. Land is structurally distinct from every other form of capital because it has three unique properties. First is a fixed supply. You cannot just manufacture more land when demand spikes, unlike, silicon chips. Second is immobility. You cannot ship a cheap acre of land from rural Ohio to downtown Manhattan to ease price pressures. And third is indestructibility. A fleet of delivery trucks will rust, software code becomes obsolete, but a plot of land literally never depreciates. Because of these three traits, commercial banks fundamentally shifted their entire operational model. Over the last 50 years, they largely stopped lending based on productive merit, meaning they stopped meticulously evaluating business plans or risking capital on new inventions, and they started lending almost exclusively based on asset possession. They transitioned from being facilitators of industrial growth into pure mortgage creation vehicles.
Let me stop you right there, because lending against land is just fundamentally prudent risk management. It provides informational symmetry. If I am a commercial banker, I can very easily appraise a physical plot of commercial real estate. I cannot easily appraise the viability of a complex, highly speculative biotechnology startup. If I fund that biotech startup and it fails, the bank is left with highly specialized, completely useless proprietary equipment. If a real estate venture fails, the bank still holds the dirt. It's indestructible, as you just said. So why should banks be vilified for choosing solid, risk-free collateral over highly risky, speculative ideas?
They aren't being vilified morally. Bird is simply pointing out the systemic consequence. When banks exclusively funnel credit towards safe collateral, they starve actual innovation. And this mechanism fuels what he defines as the productivity sponge. This is the phenomenon of passive value capture. When a municipality uses taxpayer funds to bore a new subway line, or a cluster of engineers innovates and draws talent to a specific tech corridor, the surrounding land values skyrocket. The local landowners did not dig those subway tunnels. They did not write a single line of that software. But they sponge up the financial dividends of that societal progress through aggressively higher rents and inflated property valuations. They are effectively intercepting wealth without producing a single thing.
Look, identifying which geographic area will become valuable requires genuine foresight and skill. If I purchase a vacant lot in a completely neglected, rundown neighborhood because I am betting it will become a major commercial hub in 20 years, I am taking a massive financial risk. I am acting as an entrepreneur. If my prediction is correct, my reward is the appreciation of that asset. Calling that passive or labeling the investor a sponge completely dismisses the sheer risk and the merit involved in long-term real estate development.
It is a risk for the individual, certainly, but it is a zero-sum risk for the macroeconomic system. If you invest capital into a startup that successfully develops a new medical device, you have objectively expanded the total sum of human capability you added to the pie. If you successfully speculate on a vacant lot, you have simply positioned yourself at a toll booth to extract a fee from whoever actually builds the road. You didn't build it, you just bought the rights to the gates. And the broader implication here is that this sponge effect inherently starves productive capital. If every rational investor realizes that hoarding land yields a higher, safer return than funding a volatile startup, the capital pool for actual innovation completely dries up. And you see this exact value capture dictating corporate behavior as well. Bird uses the classic McDonald's example. Harry Sunborn, their first CFO, famously realized that McDonald's was not fundamentally a food service company. It was a real estate business. They used the burgers merely as a mechanism to ensure franchisees could pay their rent on the prime locations that the corporate entity controlled. The actual wealth generation was in controlling the bottleneck of the location, not grilling the meat. This dynamic scales up to create a severe drag on the whole economy, which brings us to the zombie company problem. Data from the Bank for International Settlements reveals that companies holding significant real estate assets receive the vast majority of bank credit, completely regardless of their actual business performance. This keeps incredibly unproductive, effectively dead companies alive purely because they own dirt. Meanwhile, highly innovative startups without land holdings frequently go bankrupt simply because they cannot secure capital.
Okay, but if these companies are holding on to land, they are still participating in the market. And regarding the macroeconomic risk, you mentioned a toll booth. But bubbles always top. We have seen real estate markets crash spectacularly. When prices detach too far from reality, a recession hits, asset prices reset to a realistic baseline, the economy clears out the dead wood, and we move forward. Why is Bird framing this as an inescapable permanent trap instead of just acknowledging it as a standard business cycle?
Because the land market doesn't just clear out dead wood, it operates on a specialized land feedback loop that actively distorts the recovery. As land prices rise, existing landowners suddenly possess more collateral on their balance sheets. Banks see this increased collateral and confidently issue even more credit to those owners. That newly created credit is then overwhelmingly used to bid on more land, which drives the prices even higher, thereby creating even more collateral. It is a self-sustaining loop anchored entirely to credit momentum, completely divorced from actual economic output. Bird contrasts this specifically with historical manias like the 1890s bicycle bubble or the late 90s dot-com boom. When the dot-com bubble popped, retail investors were wiped out, absolutely. But society was left with thousands of miles of incredibly valuable fiber optic cable and the foundational infrastructure of the internet. We extracted utility from the mania. The capital was destroyed, but the productive capacity remained. When a land bubble pops, society does not get more land. The physical reality of the country hasn't changed at all. We are just left with identical patches of dirt and a catastrophic volume of unpayable debt.
I understand the distinction between productive infrastructure and fixed dirt. But again, once that unpayable debt is defaulted on, the system clears, prices plummet, new buyers enter at the bottom, and the cycle begins anew. It's painful, but it's not permanent.
It is far more permanent than a standard recession because of the balance sheet destruction it leaves behind. The clinical proof of this is Japan in the late 1980s. They developed what was referred to as the land myth, an absolute culturally entrenched belief that Japanese commercial and residential land prices could mathematically never fall. The corporate sector essentially abandoned legitimate research and development to purely speculate on real estate. The mania required such rapid turnover of property that developers frequently hired the Yakuza to forcibly clear out stubborn tenants. We are talking about extreme physical intimidation and violence just to acquire land to flip. It illustrates the sheer blunt force required to feed that credit loop.
And then the land myth broke. The bubble popped in 1991.
Exactly. And it did not just reset the market. It triggered what the economist Richard Koo defined as a balance sheet recession. The entire Japanese economy effectively stagnated for over 2 decades. Why? Because every major corporation and millions of households had to dedicate all of their available capital to paying down massive debts on real estate assets that were now completely underwater. There was zero capital available for investment in new ideas, new technology, or wage growth. They were trapped in debt servitude to the dirt. And we are watching China replay these exact mechanics right now, but on an unprecedented scale.
China's real estate market has been the primary engine of their GDP growth for years. They practically built entirely new cities from scratch to keep that engine running.
Right, and Bird breaks down exactly how that functioned. Local Chinese governments historically funded their municipal budgets almost entirely through land sales to developers. This created a closed loop where the state itself had a massive structural incentive to ensure prices spiraled eternally upward. This environment birthed hyper-leveraged giants like Evergrande, which operated effectively as a Ponzi scheme. They were constantly borrowing against inflating land valuations to purchase more land before ever finishing the initial construction.
But the Chinese government eventually stepped in to stop that exact behavior. They implemented the three red lines policy specifically to limit developer debt and safely deflate the bubble.
They tried to safely deflate it, yes. But you cannot gently deflate a credit loop of that magnitude. By introducing those strict financial metrics, they cut off the credit momentum. The entire sector immediately seized up. And this revealed the ultimate nature of the trap. The Chinese economy is now far too dependent on real estate construction to survive a sudden crash, but the real estate itself is far too expensive to allow any other productive sector of the economy to grow. They are completely boxed in.
I follow the mechanics of the Japan and China examples, but we are operating in a drastically different paradigm today, specifically regarding geography. We have transitioned into a digital-first economy. Remote work is ubiquitous. We are seeing massive demographic shifts where people are actively migrating away from ultra-expensive coastal megacities because they can log onto a corporate server from literally anywhere. Doesn't the digital economy naturally dismantle this entire land trap by making physical location irrelevant?
You would assume the decoupling of work and location would collapse the trap, but Burt argues it has simply spatialized it. The digital transition did not cause land values to crash. It actively spiked them in secondary lifestyle-oriented locations. Highly paid remote workers flooded into mountain towns, scenic rural areas, and cities like Austin or Miami, immediately driving up the cost of the dirt in those secondary markets. The fundamental bottleneck of the economy remains exactly the same. The rigidly scarce resource is still the location advantage itself.
So you're saying just move the bubble to the suburbs and the mountains?
Precisely. Because whether a major tech conglomerate needs a highly specific plot of land with the correct industrial zoning, massive water access for cooling, and proximity to a stable power grid for a new AI server farm, or a remote software engineer just wants a house with a home office near a good beach, they are both fundamentally competing for a fixed supply of desirable earth. The digital economy still requires physical infrastructure, and human beings still demand physical space.
If the trap is truly inescapable, if the market naturally financializes absolutely every desirable location, regardless of whether we are in an industrial or a digital age, is there any actual empirical evidence of a modern capitalist system escaping this? Or is Bird just diagnosing a terminal disease?
He does point to one highly effective control group, which is Singapore. They are essentially the only modern nation to successfully break the trap, and they achieved it through a radical piece of legislation called the Land Acquisition Act. Decades ago, the Singaporean government systematically acquired roughly 90% of the land in the whole country. And historically, they did not pay market rates. They often forced sales at below-market valuations, acting almost ruthlessly to secure the resource.
Okay, but what do they actually do with it? Just owning the land doesn't generate economic dynamism.
They fundamentally separated the concept of ownership. In Singapore, citizens can own their physical apartments, the structure itself, but the dirt underneath that building is retained by the state and distributed on 99-year leases. This definitively capped the speculative asset appreciation on the land itself. Housing and commercial real estate became a utility again. It became a functional place to live and do business rather than a speculative financial instrument used to park wealth. The result of this policy is a highly advanced capitalist economy with an astonishing 90% homeownership rate, completely free from the crippling, debt-fueled bubbles we see consistently in the West.
Right, but let's be realistic about the implementation here. Acquiring 90% of a country's land requires an incredibly strong, effectively unilateral state apparatus. To replicate that in the United States or the United Kingdom, the government would have to nationalize the ground beneath everyone's feet. This proves that the trap Burt is describing isn't just a flaw in banking regulations, it is entirely political. In Western democracies, the voting base is largely composed of landowners. Why would a majority of voters ever support a policy that intentionally destroys their own primary source of net worth?
They absolutely wouldn't, and that realization brings us to the final, most crucial pillar of Bird's thesis, which is homeownership politics. We have engineered a democratic system where the exact cure for our macroeconomic stagnation, which is structurally affordable housing and cheap commercial rent, is viewed as pure financial poison by the majority of the electorate. We are tracked not just by banks, but by our own balance sheets.
That is a brutally cynical view of the middle class, though.
It's clinical, not cynical. Middle-class wealth in the West is no longer primarily driven by wage growth or productive output. It is, structurally speaking, a government-sanctioned wealth transfer from the future to the present. We are systematically extracting capital from young, first-time buyers and new, innovative businesses via the credit system, purely to inflate and protect the asset values of current property owners. The system demands that the next generation take on increasingly catastrophic levels of debt just to access the basic utility of shelter, which keeps the current generation solvent. It is an intergenerational wealth transfer disguised as a functioning housing market.
So to accurately summarize this entire thesis, modern capitalism is stagnating precisely because we have willingly locked our capital into a deadweight asset. We fundamentally rely on the inflated price of dirt to prop up our personal and corporate balance sheets, rather than taking the actual entrepreneurial risk of investing in new ideas, new infrastructure, or actual production. We have collectively chosen guaranteed financial stability for those who already own property at the direct expense of economic dynamism and the prosperity of the next generation.
That is exactly the uncomfortable reality of the asset utility paradox. Breaking this trap does not necessarily require a communist revolution, but it does require a profound paradigm shift. We have to somehow stop treating land as a private collateral engine designed to extract wealth and return to treating it as the shared utility that underpins all actual economic progress.
Which leaves you with a fairly massive question to consider. As we build out the infrastructure for the next century, as we pour trillions into AI data centers, power grids, and massive fiber optic networks, are we just going to recreate this exact same trap in the cloud, effectively turning digital space into the next speculative dirt?
Modern capitalism will remain trapped in stagnation until we stop worshiping dirt and start funding actual innovation. If you want more deep dives like this, subscribe to the channel. This has been Nonfiction Insights.